We're joined this morning by Jim Stening from FIIG Securities. Jim, what do you see as the implications from where we sit at the moment, what we know for monetary policy, and how bad will the inflation picture become?
Yeah, well, morning, Brooke. Morning, Carson. Look, I think it's a very difficult thing to call at the moment. I mean, inflation will obviously be impacted by the food prices. But one thing that I think that probably isn't being factored in over the longer term is the fact that obviously there'll be a lot of jobs created or a lot of human resources required to actually rebuild the infrastructure, and at this stage we don't know to what extent it's been damaged, but we do know that it's significant. We also know that there are some significant wage pressures coming into the system through the December quarter. So I think that this is a component of the floods that perhaps people haven't considered, the long-term implications for wages. So
either way, it leads to higher inflation pressures.
Look, I think so. I mean, I think that's what generally speaking, I think that the pressure can only be up as a result of this this flood.
Mm-hmm. You know, there's also that idea that a lot of corporates were sitting on the sidelines towards the end of last year, that their own projects were therefore on hold. Is this going to in any way, do you think, have a spillover effect and just delay those projects and maybe offset those wage pressure rises?
Well, I mean, I suppose, I mean, I'm not certain what sort of sectors you're referring to there.
Well, particularly in the mining space, yeah, those big mining projects.
I guess so, yeah. I mean, look, it's going to, I mean, again, it comes down to the extent of the damage and how quickly they can revisit those projects, I suppose. But yeah, look, I mean, that certainly could be a short-term lull, short-term to medium-term lull. I think the other thing perhaps that I mean, everybody's talking about these food prices in particular being impacted in the short term, but to the extent that infrastructure, that agricultural infrastructure is damaged, that may be a more medium-term impact as well.
And of course, we know that that's going to add to the costs for the Queensland State Government. We just spoke with the Treasurer, Andrew Fraser. From a bond market perspective, what are the implications that you're watching?
Well, I guess, I heard you guys mention this earlier when you were talking to Andrew. I think, obviously the rating of the Queensland as an issuer, as a state, obviously that's in focus at the moment. The term double whammy was used. That's exactly right. I mean, we don't know the extent of the damage. We don't know the cost of the rebuild, and of course we don't know the other side of the balance sheet either, the impact on revenue. This is still up in the air, but it will be substantial. I'm not certain that any downgrade would be hugely material, but it is something to factor in. Also, obviously the federal government will be committed to rebuild expenses as well.
They'll be looking to get money from somewhere, I suppose, Jim.
That's right. It means more bonds, I suppose, broadly speaking. These are very obviously very highly rated issuers. So I suppose supply will play a role. That may push out margins a little bit.
How much does this sort of work as a setback to Julia Gillard's sort of avowed intentions and Treasurer Wayne Swan to balance that budget, in the time frame they'd set themselves?
Well, I guess, again, we don't know the extent of the damage here or the cost, but one would assume that could serve to delay it unless some savings can be made on spending in other areas.
That is the thing, isn't it? Because there's been this talk of, a spending blowout, more broadly speaking, particularly when you talk about that pressure to attract workers on infrastructure. How does the federal government respond with public sector jobs if it doesn't raise wages?
Well, that's right. I mean, I think that, there's pressure building there, and I think that this actually does make it more acute. It's a problem, and I think that's why, from the Reserve Bank's perspective, this is a very difficult time to be managing monetary policy. I mean, we started to see the effects of the, if you like, surprise tightening. Obviously, the Reserve Bank's not meeting this month. They seem to do that every year, but I think we have started to see a bit of a slowdown over the Christmas period, coming through in some statistics. It's just very difficult. Their target is inflation, and obviously if GDP is going to contract by 0.5%, and if inflation's going up, then that just makes it difficult.
And Jim, just a final thought on the global picture. We're out of time, but we might pick this up on a future program. We're seeing the US Treasuries are very much in focus, and the US economic data really starting to pick up. There's genuine optimism about a recovery there, it would seem now. What do you see as the flow-on effects again for the Australian bond market?
Yeah, well, look, my strong view is that the Australian bond market will continue to outperform. You know, we saw this love affair in last year with the story of deflation in the US. That didn't materialise. In fact, we had all of the regulators and the Fed, you know, pushing to reinflate the economy. It now looks that's going to be successful. It's early days. So I think we're going to see upward pressure on rates here, but I do think that that spread between US and Australian bonds will contract significantly over 2011.
Jim, I think we have to pick it up, as I said, on a future program. I know Carson's desperate to ask you a question. We've got to move on for today, though. Thank you.
Okay, thank you.
Jim
Cheers.
Stening from